If you woke up today with fresh eyes and zero investments, what would you actually do? Not what the textbooks say, not what your uncle told you at Thanksgiving. What would a genuinely rational person do right now with the markets where they are, the economy doing what it's doing, and all the noise that comes with living in this particular moment in history? That's exactly what we're diving into today. And I promise you, some of what I'm about to say is going to challenge things you think you already know. Before we get into it, I want you to picture something. Imagine two people. Both of them are 28 years old. Both of them earn the same income. Both of them decide to start investing in 2026. One of them follows conventional wisdom, the generic advice that gets recycled on every finance blog and every generic YouTube channel. The other one thinks carefully, adapts to the current environment, and builds a strategy that actually makes sense for where we are right now. In 10 years, those two people are going to look at very different account balances. And the gap between them isn't luck, it's decisions. The decisions we're going to talk about right now. Let's start with the single biggest mistake that almost every first-time investor makes. And it's not what you think. It's not picking bad stocks. It's not investing too late. The biggest mistake is having no clarity on why you're investing in the first place. This sounds simple, almost annoyingly simple, but hear me out, because this is genuinely foundational. When you don't know your why, you make emotional decisions. When markets dip, which they will, you panic. When something rockets up 40% in 3 months, you chase it. You become reactive instead of intentional, and reactive investors consistently underperform the market. Studies have shown repeatedly that average investor returns trail the actual market returns significantly. Not because the market is hard to beat, but because human beings are terrible at staying disciplined when emotions are running high. So before you put a single dollar anywhere, you need to get honest with yourself about 3 things. First, what is this money actually for? Retirement in 30 years? A house in 7 years? Financial independence in 15 years? These different goals require completely different strategies. Second, what is your real risk tolerance? Not the risk tolerance you think sounds impressive when you say it out loud, but the tolerance you'd actually have when you watch your portfolio drop 25% in 2 months. And third, how much can you consistently invest without it disrupting your actual life? Because consistency, over everything else, is the secret weapon. Now let's talk about where the world actually stands in early 2026, because context matters enormously in investing. We've come through years of significant economic turbulence. Interest rates have been through a dramatic cycle. The artificial intelligence revolution has fundamentally changed how we think about productivity, business valuations, and the future of entire industries. Geopolitical shifts have reshuffled global supply chains. And the average investor right now is sitting in a landscape that looks genuinely different from what it looked like a decade ago. This isn't doom and gloom, it's just reality. And the investors who succeed are the ones who invest in reality, not in the market of 5 years ago. Here's the first concrete thing I would do if I were starting from scratch today. I would build what I call my financial foundation before I touched a single investment account. This means having an emergency fund of 3 to 6 months of expenses sitting in a high-yield savings account. It means having no high-interest debt because paying off a credit card charging you 20% interest is genuinely better than almost any investment you could make. It means understanding your monthly cash flow well enough to know exactly how much you can invest without strain. This foundation isn't exciting. Nobody makes YouTube videos about having an emergency fund because it doesn't get clicks. But without this foundation, the first market correction you experience is going to terrify you into selling at exactly the wrong moment. With the foundation in place, here's where I would start investing. And I want to be direct about this because there's so much noise out there. I would open a tax-advantaged account first. In the United States, that means maxing out a Roth IRA or contributing enough to your 401k to at least capture your full employer match, if you have one. The reason this matters so much is that tax-advantage growth is genuinely one of the most powerful forces in long-term wealth building. The math on this is staggering when you run the numbers over 20 or 30 years. You are essentially getting a significant portion of your returns for free because the government isn't taking their cut along the way. Now, inside those accounts, what would I actually invest in? This is where a lot of people expect me to start rattling off hot stock picks or sector plays, and I'm going to disappoint you in the best possible way. If I were starting today with a long time horizon, my core position would be broad market index funds. I know, not exciting, but let me tell you why this isn't just generic advice and why it's specifically relevant to 2026. The case for index investing has never been stronger, not because markets are easy, but because the data on active management has become increasingly brutal. The overwhelming majority of actively managed funds underperform their benchmark index over 10 or 15-year periods. Not some of them, the vast majority. When you're starting out, outperforming the market shouldn't even be your goal. Matching the market consistently with low fees is the foundation of serious wealth building. I would hold a total market index fund as my primary position. This gives you exposure to thousands of companies across every sector, every market cap, every corner of the economy. When one sector struggles, others compensate. When innovation creates new winners, you own them automatically. There's no maintenance, no endless research, no anxiety about whether your picks are right. It just works, quietly, over time. But here's where I would adapt to the current environment in 2026 specifically. I would not go all in on only U.S. equities. Depending on where international markets stand relative to U.S. markets in terms of valuation, there's often a compelling case for international diversification. Historically, different markets take turns leading performance over different decades. The United States had a remarkable run of outperformance, but valuations matter over the long run, and having exposure to global growth is simply prudent. I would hold something in the range of 20 to 30% of my equity allocation in international index funds, both developed markets, and a smaller allocation to emerging markets for their long-term growth potential. Let me stop here for a second and address something I know is going through a lot of your minds. What about AI? What about the tech revolution? What about the obvious winners that are going to define the next decade? I hear you. And look, I'm not going to pretend that we're living in a normal moment in history. The AI revolution is real. It's already transforming productivity, reshaping industries, and creating genuinely enormous wealth for investors who positioned correctly. But here's the thing that people don't talk about enough. Identifying the right sector is only half the battle. The other half is not overpaying for it. The biggest investing disasters in history have come from people who correctly identified the right trend, but bought in after everyone else already knew about it at prices that made future returns impossible. If you want exposure to AI and technology, a total market index fund already gives you significant exposure to the largest technology companies because they make up a substantial portion of market cap weighted indexes. If you want to tilt further toward technology, a technology sector fund or a broad innovation-focused fund gives you that tilt while still spreading risk across many companies rather than betting on just a handful. I would be very careful to concentrate too heavily in any single theme, no matter how obvious it seems. The obvious trades are often the most crowded, and crowded trades are dangerous. Now let's talk about bonds and fixed income, because in 2026, this conversation is genuinely more interesting than it's been in a long time. After years of a very unusual interest rate environment, fixed income has reestablished itself as a legitimate asset class for investors who understand how to use it. For someone just starting out who is young and has a long time horizon, I would keep bond allocation relatively modest, maybe 10 to 15% at most. Bonds provide stability and dampen volatility, which psychologically helps investors stay in the market during rough patches. But too much in bonds when you're young means sacrificing the long-term growth that equities provide. Here's something specific I would do in 2026 that I think is underappreciated in the investing conversation. I would establish the habit of automatic investing from day one. Not investing when I feel like it, not when the market looks good, not when I feel financially confident. Every single month, automatically, a fixed amount gets invested. This is the mechanical implementation of dollar cost averaging. And the reason it works so powerfully is that it removes the decision from the equation. When markets drop and the news is terrifying, the automatic investment goes through anyway. When markets are rallying and everyone is euphoric, the automatic investment goes through anyway. Over time, you buy more shares when prices are low and fewer when prices are high, and your average cost basis tends to be very favorable. More importantly, you don't have to be smart about timing because you've engineered a system that doesn't require it. Let me share something about the psychology of starting to invest that almost nobody talks about honestly. The beginning feels terrible, not because of the market, but because of scale. When you start investing and your portfolio is small, market movements feel almost meaningless and the progress feels painfully slow. You invest for 6 months and you have a few $1,000s and the market moves 2% and you made or lost a few $100 and it feels like, what's the point? This is the hardest phase of investing, and it's the phase where most people give up or start doing stupid things to try to accelerate their results. Buying lottery ticket stocks, chasing memes, trying to day trade. All of those behaviors destroy long-term wealth, and they all come from the psychological discomfort income growth in your total wealth building picture. A lot of people treat investing as if it exists in isolation from the rest of their financial life, but the amount you can invest is directly tied to the gap between what you earn and what you spend. For most people starting out, the single highest return investment they can make is in their own skills, their own career trajectory, their own earning power. Going from earning $40,000 a year to earning $80,000 a year has a more profound impact on your long-term wealth than virtually any investment decision you could make. I would be investing aggressively in my own human capital, taking on challenges that accelerate my career, building skills that compound just like financial assets do. The second most underrated factor in the wealth building equation is controlling lifestyle inflation. This is the silent killer of wealth for people who actually earn good incomes. As your income grows, the temptation to upgrade every aspect of your lifestyle grows with it. Bigger apartment, nicer car, more expensive vacations. And none of these things are inherently bad, but every dollar that goes to lifestyle instead of investment is a dollar that doesn't compound for 30 years. The wealthy people I've studied, not the ones who appear wealthy, but the ones who actually have the balance sheet to prove it, almost universally have a habit of keeping their lifestyle relatively modest relative to their income and routing the difference into investments. They don't do this because they're miserable. They do it because they genuinely understand what they're trading, and they've consciously decided that future freedom is worth more to them than present consumption. Let's talk about what I would actively avoid if I were starting in 2026, not just because these things are risky, but because they're specifically dangerous for new investors. First, I would avoid individual stock picking as a significant portion of my portfolio. This isn't because individual stocks can't make you wealthy, some clearly can. It's because the research consistently shows that most individual stock pickers underperform index funds. And even when they outperform, it's often not clear whether it was skill or luck. As a beginner with limited time to research companies deeply, the odds are not in your favor. If you want to own individual stocks, keep it to a small slice of your portfolio, maybe 5 to 10%, that you genuinely don't need to outperform the market. Second, I would be deeply skeptical of anyone promising extraordinary returns with limited risk in any specific asset class. This includes certain corners of crypto, certain leveraged products, certain private investment schemes that target young investors who are hungry to build wealth faster. The pattern here is always the same. Someone is making money off of your investment activity, not off of their own successful investing. Real wealth is boring to watch build. Anyone making it sound exciting is probably making it exciting for themselves at your expense. Third, I would avoid the constant consumption of financial news and market commentary as if it were educational. Most financial media is designed to keep you watching, not to make you a better investor. The urgency, the breaking developments, the experts with conflicting opinions, all of it creates anxiety and provokes action when the vast majority of the time, the right action is to do nothing. I would consume investing education thoughtfully and intentionally. Books, long-form content, actual research, but I would dramatically limit my exposure to the daily noise machine. I want to spend a few minutes on something that I think separates truly successful long-term investors from everyone else. It's the concept of having a written investment policy, a simple document where you define your goals, your allocation, your rules for rebalancing, and your behavior in market downturns before those downturns happen. This sounds overly formal for a regular person, but it serves an incredibly important purpose. When markets are crashing and every instinct in your body is screaming at you to sell, having a document you wrote to your future panicking self that says, "This is what we're going to do and why," is genuinely powerful. It's a way of having a rational conversation with yourself across time. Most investors have no rules, they just react. The ones with written rules actually follow a strategy. Rebalancing deserves its own mention here. As your portfolio grows and different assets perform differently, your allocation will drift from your original targets. Rebalancing means periodically selling some of what has grown and buying more of what has underperformed to get back to your target allocation. This is counterintuitive because it means selling winners and buying losers, which feels wrong emotionally, but it enforces the buy low, sell high principle mechanically and keeps your risk profile aligned with your actual intentions. I would rebalance once or twice a year, not more frequently, using tax-advantaged accounts to avoid triggering taxable events wherever possible. As we approach the end of this, I want to zoom out and talk about the mindset that I think makes all of this work. Because truthfully, the mechanics of investing, index funds, tax accounts, automatic contributions, rebalancing, all of that is not complicated. Any reasonably intelligent person can understand and implement in an afternoon. The thing that separates the investors who build real wealth from the ones who don't isn't knowledge, it's patience combined with trust in a process during periods that process feels like it's failing. Markets will go down. In your investing lifetime, you will experience multiple significant crashes. You will watch your portfolio lose 20%, 30%, possibly more at some point. And in those moments, the news will be dire. The experts will be predicting further catastrophe, and every short-term signal will be saying, "This time is different. This time it's all falling apart." And almost certainly, if history is any guide, those moments will turn out to be the best buying opportunities of your investing lifetime. The single best thing you can do to take advantage of those moments is to already be in the market, already have a plan, already have the emotional foundation to stay the course. The investors who win over 20 or 30 years are not geniuses. They're not experts at reading market cycles or picking stocks. They're people who started early, invested consistently, kept their costs low, diversified sensibly, and refused to let fear or greed knock them off course. That's it. That's the entire formula, and it's available to absolutely anyone willing to do the unsexy work of following through on a simple plan for a very long time. So, if I were starting today on February 27th, 2026, here's what I would do in plain terms. I would sort out my financial foundation first. I would open my Roth IRA or maximize my 401k match immediately. I would invest that money in low-cost, diversified index funds, covering U.S. stocks, international stocks, and a modest bond allocation. I would set up automatic monthly contributions, and then I would go live my life. I would focus on growing my income and controlling lifestyle inflation. I would read one genuinely good book about investing every quarter and otherwise ignore the daily market noise. I would have a written plan for what I would do in a crash, and I would trust that the process that has worked for disciplined investors for generations will continue to work for me. The best time to start was yesterday. The second best time is right now. Wherever you are in your journey, the most important step is the next one. Start. Keep it simple, stay consistent, and let time do what time does best. If this helped you think more clearly about your own approach to investing, make sure you like, comment, and hit that subscribe button, because we're going to keep going deeper on these topics in ways that I genuinely believe will change how